The capital asset pricing model, CAPM, is a commonly used method for estimating the cost of equity capital. To calculate the cost of capital using CAPM, you will need to follow these steps. Determine the risk-free rate. The first step is to identify the risk-free rate, which is the return on a theoretical investment that has no risk. A common approach is to use the yield on long-term government bonds, as they are considered to be relatively safe investments. Determine the market risk premium. The market risk premium is the additional return investors require for investing in a stock market as opposed to the risk-free investment. This can be estimated by subtracting the risk-free rate from the expected market return, which is the average return earned by investors in the market. Estimate the beta of the investment. The next step is to estimate the beta of the investment, which is a measure of the investment's volatility relative to the market. The beta can be estimated by comparing the investment's historical returns to the returns of the market as a whole. Calculate the cost of equity. The cost of equity is calculated using the following formula. Cost of equity equals risk-free rate plus beta x, market risk premium. For example, if the risk-free rate is 3%, the market risk premium is 7%, and the investment has a beta of 1.2, then the cost of equity would be cost of equity equals 3% plus 1.2 x 7% equals 11.4%. This means that the investment would need to earn at least an 11.4% return to compensate for the risk taken by the investor. It's important to note that while CAPM is a widely used method for estimating the cost of equity, it has some limitations and may not be suitable for all investments or situations. Additionally, the cost of capital is typically calculated as a weighted average of the cost of equity and the cost of debt, so the CAPM may only be one component of a broader cost of capital calculation.